You could have the exact same income as your neighbor, but if your credit score is 200 points lower, you'll pay an extra $250,000 over your lifetime. Most people think credit scores just affect loan rates, but they're actually determining where you can live, what jobs you can get, and whether you'll ever build real wealth. Here's the thing, nobody tells you about credit scores. They're not actually measuring how good you are with money. They're measuring how profitable you are to lenders. Someone who pays off their credit cards in full every month looks almost identical to someone who carries a small balance and pays interest. The system rewards you for being a reliable profit center, not for being financially responsible. This explains why your credit score operates on such a bizarre scale. The range goes from 300 to 850, but you'll never see anyone with a 300 unless they've declared bankruptcy multiple times or have dozens of defaults. Most people start somewhere around 500 to 600 when they first get credit, and the majority of Americans sit between 600 and 750. Getting above 800 requires playing a very specific game that has almost nothing to do with your actual financial health. The score itself comes from 5 main factors, but they're weighted in ways that seem designed to confuse you. Your payment history matters most, but missing one payment can drop your score by dozens of points, while making payments on time for years barely moves it up. The amount you owe matters, but it's not the dollar amount. It's the percentage of your available credit you're using. Someone with a $1,000 limit who uses $200 looks worse than someone with a $10,000 limit who uses $2,000. But here's where it gets really twisted. The system actually punishes you for being too responsible. If you pay off all your credit cards and close the accounts, thinking you're being financially smart, your score will actually drop. The system wants to see you managing credit, not avoiding it. This is why people who've never had debt often struggle to get approved for mortgages, despite having substantial savings accounts. You're being penalized for not generating enough data about your borrowing behavior. The length of your credit history creates another catch-22. Opening new accounts hurts your average account age, but you need different types of credit to maximize your score. So you're supposed to keep old accounts open forever, even if they have terrible terms or annual fees, just to maintain that history. Meanwhile, every time you apply for credit, your score takes a temporary hit from the inquiry itself. This system becomes especially cruel when you're trying to rebuild after financial hardship. Let's say you had perfect credit for 15 years, then lost your job and missed some payments during a 6-month rough patch. Those few missed payments can drop your score by over 100 points, but getting back to where you were will take years of perfect behavior. The algorithm treats your decade and a half of reliability as less important than those recent missed payments. The credit utilization rule is particularly insane. Using more than 30% of your available credit hurts your score. But so does using 0% consistently. You're supposed to use some credit every month, but not too much, and pay it off, but not too quickly. The sweet spot appears to be using between 1 and 10% of your limit and paying it off just before your statement closes. But the real kicker is how dramatically your score tier affects your actual life. Between a 620 credit score and a 760 credit score, you're looking at completely different financial realities. With a 620, you'll pay roughly double the interest rate on a mortgage compared to someone with a 760. On a typical home loan, that translates to an extra $200 to $300 per month, which over 30 years becomes 6 figures in additional interest payments alone. But the differences go way beyond borrowing costs. Many landlords won't even consider tenants with scores below 650, effectively locking you out of entire neighborhoods. Insurance companies use credit scores to set your premiums, so poor credit can add hundreds to your annual car and homeowners' insurance bills. Some employers run credit checks, particularly for financial positions, meaning your credit score could literally cost you job opportunities. The psychological impact creates a vicious cycle that's hard to break. When you're stuck in the lower credit tiers, you're forced into subprime products with terrible terms. You might get approved for a credit card, but it comes with a 29% interest rate and a $50 annual fee. Your car loan gets approved, but at 12% interest instead of 4%. Every financial product you touch becomes more expensive, making it harder to build the stability needed to improve your score. People with excellent credit live in a completely different ecosystem. They get pre-approved for everything, receive promotional rates, and have access to rewards programs that essentially pay them to borrow money. Meanwhile, if your score is below 600, you're often forced into secured cards and subprime loans that feel designed to keep you trapped. The most frustrating part is how slowly scores improve compared to how quickly they can drop. Missing one payment can tank your score overnight, but rebuilding from that mistake takes months or even years of perfect behavior. The algorithms are designed to be much more sensitive to negative information than positive information. This isn't an accident, it's a feature that keeps people trapped in lower score ranges where they're more profitable to lenders. The speed difference is staggering. Your score can drop 40 to 60 points from a single 30-day late payment, but getting those points back requires consistent on-time payments for 6 months minimum. If you max out a credit card, your score plummets within weeks when that high balance gets reported, but paying it down to zero might only recover half those lost points, and getting back to your original score could take a full year. This creates what financial experts call the credit score treadmill. You're constantly working just to maintain your position, and any slip sends you sliding backward faster than you can climb forward. The system is particularly brutal during life transitions when you're most vulnerable. Getting divorced, changing jobs, or dealing with medical bills can trigger a cascade of credit problems that take years to resolve. The timing of when your balances get reported adds another layer of complexity most people never realize. Your credit card company reports your balance to the credit bureaus once per month, usually on your statement closing date. This means you could pay off your entire balance the day after that snapshot gets taken and still show a high utilization ratio for the entire next month. Smart credit users game this system by tracking their reporting dates and paying down balances strategically. But here's what happens when you finally crack the code and reach the top tier. Once you break into the 750 plus range, the financial world starts working for you instead of against you. Banks compete for your business with promotional rates that seem almost too good to be true. 0% financing on cars becomes standard. Credit cards offer sign-up bonuses worth hundreds of dollars just for spending money you are going to spend anyway. You're essentially getting paid to borrow money, while people with poor credit are getting charged premium rates for the privilege. The psychological shift is just as dramatic as the financial benefits. When you have excellent credit, you stop thinking about whether you'll get approved and start thinking about which offer gives you the best terms. You're no longer grateful that someone will lend to you. You're choosing between lenders who want your business. This confidence bleeds into other areas of your financial life, making you more likely to negotiate better deals and ask for what you deserve. But here's the weird part about reaching the top credit tiers. The differences between a 760 and an 850 are almost meaningless in practical terms. Most lenders offer their best rates to anyone above 740 or 760. That perfect 850 score is more of a trophy than a financial tool. You'll get the same mortgage rate at 780 as you would at 850, but the journey from 680 to 780 can save you hundreds of thousands over your lifetime. The real secret that high-score individuals understand is that credit scores are just one piece of a larger wealth-building strategy. They use credit as a tool to leverage opportunities, not as a crutch to afford lifestyle inflation. But getting to that point requires understanding exactly how to move between each credit tier systematically. Subscribe for more financial reality checks and watch this next video about the credit card mistakes that are costing you thousands.